Chief Commercial Officer, Sales and Replenishment, Mr. Vipin Kataria, Chief Marketing Officer, Mr. Amit Doshi, and Chief Procurement Officer, Mr. Manoj Balgi. The analyst deck is uploaded on our website. Before I pass it on to Mr. Varun Berry, I would like to draw your attention to the safe harbor statement in the presentation. Over to Mr. Varun Berry with remarks on the performance.
Good morning, everyone. So let's jump to the deck. So page 3 of the deck. So this gives the parameters for the quarter. So our revenue growth were 9%, which actually incorporated a transaction growth of 9% as well. Operating profits grew by 37%, and our market share was stable. However, the gap with the second largest competitor became much larger this quarter. Moving on to our strategic pillars, you've seen these: distribution, marketing, innovation, adjacent businesses to contribute more as we go forward, cost efficiency programs, which we've been running for quite some years now, and sustainability, which together will drive profitable growth for the company. Moving on to slide number 5. So if you were to look at our distribution, we are now at about 26.7 lakh outlets total. Our focus states growth has been much higher than our growth for rest of India. So focus states have continued to grow at a faster clip, which is 2.2 times what we've grown in the rest of India. Our rural distribution continues to move up. We are at 28,000 rural distributors now, and we, as we speak, we are scaling this up even further. Slide number 6. Key marketing activities. So we focused on Marie, Milk Bikis, Pure Magic, 50/50, Croissant, Winking Cow, and we've also started the Marie My Startup Season 4. The rewards and recognition programs, that we participated in. We were chosen the FMCG brand out of home by Kantar. And our marketing team got the Marketing Team of the Year award at the ET Sharks Award for 2023. So proud moments for us. We've run some consumer promotions, which are a mix of items as well as grammage impact. The grammage impacts have been more to make sure that we remain competitive. As inflation has receded, the local competitors have started to bring in more grams in bag, so we are making sure that we remain competitive with that. Innovation, we've had a very interesting product launch in Jim Jam Pops, and we've got some very interesting advertising as well behind it. We've also launched the multi-grain rusk, which has been launched in West and South only for the time being. We've also scaled up 50/50 Golmaal, which is doing extremely well for us. We've also had a robust season for Winking Cow with a wide range of offerings. So we obviously have transitioned to the PET bottles, which are doing really well. These are aseptic PET bottles, and the line is in Ranjangaon. It's an expensive line, but it's eco-friendly because you use less plastic, as well as the quality of the product, because you're not, subjecting it to very high heat, is a lot better. It's not burnt. It's product which is much better than a heat-treated product. And we've also launched rich milkshakes and coconut water this season. And we've had very high double-digit growths as far as drinks is concerned. And innovation contribution has been greater than 10%. So moving on, adjacent businesses are also on reasonably strong footing. I wouldn't say absolutely strong footing. Cake, we have been scaling up our innovations. We've launched the Big Swiss Roll. We've also done cupcakes. And sequentially, we've moved up on cakes, but post-COVID, this is one category which seems to be still coming into its own. But we've seen green shoots this quarter, and we are absolutely confident that cake is moving in the right direction. Rusk, again, we've strengthened our portfolio with regional core flavors like butter rusk, which is East-dominated product. And our local competitor had a large play in that. We've just launched that. We've also scaled up milk rusk in Kerala. And bread, we continue to grow profitably as far as this product is concerned. On rusk, we again, it's been a lot of local competition. There are about 2,500 local competitors all over the place, more so in the north. And we have made sure that this quarter we became competitive. Obviously we can't match the local competitors, but we became a lot more competitive than we were. And we are confident that as we move forward, even in this category, we will gain muscle. You know that this category contributes a reasonable amount of top line as well as good profitability as well to us. So we are making sure that we become competitive and we deal with each region in a different way. South, East and West are different, North is different, and that's how we are making sure that we deal with this category. International has been a good story. Middle East and Africa has been growing in high double digits with much improved margins. We've seen a double-digit profitable growth in the rest of international as well, led by the Americas. Nepal continues to be a very good story with a high double-digit growth and expanded margins. We've started business in Egypt, where it's doing extremely well. And Kenya is, we've got a joint venture there. We've had a little bit of starting trouble with some forex issues there, but we are very confident that even the Kenya business will come in line as we move forward. So international has been a decent story for us with very good growth. Dairy, as I spoke about, the winking cow products are doing very well. We've taken, the change of identity as far as cheese is concerned. Britannia, the laughing cow, is now, moving forward, going to be a very big driver for growth. And we've launched the laughing cow portions, which is that round box that you see in the center, and it's doing really well. And we are starting to launch our 10 rupee sachets of cheese as well. And we hope to see a very, very good growth as far as dairy is concerned. Supply of SMP, which is, our milk powder, and our sweetened condensed milk and butter for captive consumption has started from our factory to our bakery division, and that's going well. Moving on to the next slide, which is slide 9. Cost efficiencies across verticals have been moving well. As you know, the themes have been, fuel consumption, renewable energy, market damages that we receive back from the market, distance traveled, truck utilization, and line throughputs. And we've been making good progress in each one of these. And our target for 23-24 is 7 times what it was in 13-14. So we are stepping up this cost reduction program every year, and we've been able to do so. And you've got to remember once again, that this is not anything which is carried over from the last year. The meter starts on the first day of the year and ends on the last day of the year, as far as this is concerned. Moving on to slide number 10, we've set up some really good factories And this year we've scaled up Barabanki, which is in UP. So we scaled it up in Q1 of 23-24. We've got 5 lines running there, and that's a factory which is starting to perform at efficiency currently. Similarly, Tirunelveli, which is in Tamil Nadu. Both of these factories, we are grateful to the UP government as well as the Tamil Nadu government for the incentives that it's provided for us. And this is giving us capacity in the right place and helping us improve our freshness to market as well. Moving on to ESG. Now on ESG, we continue to follow our programs on people, resources, governance, and growth. Some of these are outlined here. Just to let you know, we won the award by the business world of being in the top 30 most sustainable companies in 2023. We are very proud of that. We've also been shortlisted for the World Sustainability Awards for 2023. Some of the achievements in this area have been 100% plastic neutrality. We have moved our Dow Jones score to 53rd, which is third amongst the FMCG peers in India. Our sugar and sodium has been reduced by 2% and almost 8% respectively. And we've been recognized, as I said, as one of the top 30 India's most sustainable companies. So very proud of this, and we are making sure that we take this agenda to the next level in this year. Moving on to our malnutrition reduction programs, we've extended this to 2 new centers, and we have we made sure that we've also helped refurbish the Jerbai Wadia Hospital, which is a part of the Nauroji Wadia Maternity Hospital. And we now have 470,000 patients which are being treated in this hospital. We've also got 37 lakh patients who've been treated in the last 10 years with 925 beds dedicated to these patients. We've also got other CSR initiatives which have been extended to 131 new villages. We've got, the Nutrition Foundation helping with, we've gone to additional 625 schools. We've gone to almost 700 new Anganwadi centers, and we've got now 250,000 beneficiaries of this program. So good progress there as well. So now moving on to slide number 14, which is a view on what's happening on the commodity costs. On the commodity side, flour has been, there has been inflation as far as flour is concerned. So if you look at versus last year, there's been an inflation of about 3%. Now, these are numbers for us. Obviously, the numbers, because we were covered last year, our inflation last year's numbers for us were much better than the industry. Other companies probably have seen a flattish story as far as flour is concerned. Palm oil has been a huge deflation. We've seen a deflation of almost 21%. On sugar, there's been a slight inflation of 1%, and versus last quarter, it's been an inflation of 2%. On laminates, again, there's been a deflation versus last year of 18%, and versus last quarter of 3%, and similarly on corrugated boxes. So basically, slight inflation on flour and sugar, and deflation on the other commodities that we buy. So moving on to slide number 15, on the cost and profitability front, we've initiated pricing actions to stay competitive and drive market share. Now, as I was saying on the last slide, some of the companies had not covered as well as we did last year. So their commodity prices were much higher than us last year. So they have seen a deflation which is much larger than what we've seen this year. And as a result of that, there's been quite a few price corrections which have happened in the market. Being the market leaders, also we had taken the first mover advantage on all price increases because we wanted to make sure that all inflation was covered. So there were lots of corrections which had to be made because in certain cases some large competitors had taken pricing downsides, and in certain cases they had not followed us on the price increase. So on a case-to-case basis, we've looked at what needs to be done to make sure that we remain competitive. We've also increased our advertising and sales promotion to support our brands and drive innovation. We've obviously doubled down on cost efficiency programs across all functions to make sure that we remain extremely competitive and we remain the lowest cost operators in our categories. So on an outlook basis, we are very vigilant on competitive pricing actions. We are also closely monitoring stock price situation of commodities. And finally, we are employing the necessary pricing strategies which would be deployed to remain competitive and drive market share as well as drive profitable growth in the future. So as a result of that, our numbers for the quarter have been very healthy. If you go to slide number 17, we've had on the top line, we've had a 12-month growth of 9% and a 24-month growth of 18%. And if you go to the next slide, our operating profit has grown in the 12 months at 37% and in the 24 months at 22%. So fairly healthy and robust growths on both top line as well as bottom line. Moving on to slide 19, this gives our certain parameters on. So I've already spoken about the top, the top table. So net sales 9% and 18%, operating profit 37% 12 months, 22% 24 months, profit before tax 34% 12 months and 17% in 24 months, and PBT again similarly 36% and 17%. If you were to look at some of our ratios, profit from operations still a very healthy 15.6%. Profit before tax is at 15.7%, and profit after tax remains at a very healthy 11.5%. So that's where it is. Obviously some factors. There were some profits which were booked last year, so we are cycling certain profitability which was taken for a larger period. And we will take that in our questions as I'm sure you'll have questions on that. So that's all from me. Let's open the house for questions.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Abneesh Roy from Nuvama Institutional Equities. Please go ahead.
Yeah, thanks. I've got three questions. So my first question is on the volume growth, which was flattish. So could you elaborate what exactly you have done in terms of several pricing initiatives? And in case you have passed on grammage back to customer, when do you see the volume trajectory benefiting because of that? Because if you have passed on grammage, why is the volume still flattish? And related question to this is, when I see the market share data which you have given, number two player has lost significant market share, but that benefit does not seem to have come to us. You have also lost, I think, a bit market share. So is this data credible? And if it is credible, who has gained the market share?
Yes. So Avnish, that was like being in a firing squad with many questions coming my way. So, let me just understand. Your first question was on volume growth, was that?
Yes.
Yeah. So, Avnish, the fact is that we've not equated prices everywhere. We have taken, a very cold call on what is necessary and what is not. Second is that the markets are a little sluggish compared to what we've seen in the past. What we've seen this quarter, and I'm not sure, I think I've heard the same commentary from other FMCG companies as well. There has been sluggishness in the rural markets, even for us. While we've been growing faster than the market in rural, the sluggishness is definitely there. And even the urban markets, while modern trade has been robust, and so has e-com, the traditional trade markets, both in rural and urban, have been little more sluggish than what we've seen in the past. But these are all passing phases. What we've seen in the past as well is that we tend to get overly worried about a quarter which is a little slow on a certain channel growth, but it sort of eases out, and we are seeing, I would say, slight signs of that happening, although it will take a little bit of time for the growth to pick up. You are right about market share. We have been flattish, and the reason for the gainers of market share have been all local players. So the local players, because of the pricing actions that they're taking in their small vicinities, have gained a little bit of market share. And that's a phenomena that we've seen in the past as well. When the inflation is high, local players just walk away. And when things start to become a little more normalized, local players come into the market and start to operate large schemes for customers as well as consumers. So that's what we are looking at currently. It's a matter of 1 or 2 months, and we are very confident that with all the actions that we've taken, and most of the actions have been back-ended in the first quarter, we are very confident that we will be back and we will get back onto our trajectory. So does that answer your question, Avnish? Did I miss out anything from your firing squad?
Only one thing. So in terms of pricing, it's largely price cuts in select SKUs, or is there grammage addition also which is happening?
No, so it's basically grammage additions that we've done in certain cases, and in certain cases we are looking at doing some article promotions and price cuts. So it's a mix of all, Avnish.
So thanks. My second question is on dairy. So in dairy, you have mentioned captive consumption of SMP, SCM. So what does it translate in terms of, say, any savings in terms of cost? And second is this new brand architecture has already been done in terms of the Laughing Cow. In terms of distribution next 1 to 2 years, what kind of scale-up could be there? Because now, obviously, you will become more affordable to consumer gradually as your supply chain and manufacturing becomes normalized. So if you could elaborate on both these aspects.
So, So what it does is it helps us fulfill our commitments to the farmers. We are collecting a lot of milk from our farmers. We are processing that, and we are whatever is required from the company's perspective, we are fulfilling that. At this point, there is no cost advantage of doing that, but there is no cost disadvantage either. We are in the process of scaling up our factories, and yes, once we scale them up fully, we will start to see cost advantages as well. On the cheese part of the business, yes, we are really looking forward. The initial signs are looking very positive, Avnish, on cheese, and we are really looking forward to good growth. We don't give forward-looking statements, so I won't give you a number on that. But all I can tell you is that we are very optimistic on what we can do with our cheese portfolio now.
So one last very quick question. So on cake and rusk, your commentary was that not very strong, reasonably strong in terms of growth. And you have been doing innovation very aggressively over the past many quarters. So what is the issue here? Is the overall market not living up to the initial expectations which you had, or is there again a pricing and the regional competition which is also there?
So it's a mix of both. One is the market growths have been a little tepid, and second is that regional competitors, again, similarly what I told you about biscuits, same phenomena is happening here as well. And as I told you, there are 2,500 regional competitors as far as rusk is concerned. So the onus of making sure that we protect ourselves and grow our business and make sure that we do what is right for the business is on us. And we've commissioned rusk lines all over the place. We never had our own rusk line in the north. We've just commissioned it in UP. That will give us a major advantage as far as rusk is concerned in UP, and similarly in Ranjangaon. And so this is now we are taking rusk capacity also in-house, which will give us a big advantage, not just from a cost perspective, but also from a quality perspective. Avnish, you've taken almost 30% of the time with your firing squad. Okay.
I am done, sir. Thank you.
Okay.
Thank you so much. A request to all the participants, please restrict to 2 questions per participant so the management can address all the questions from all the participants. Next question is from the line of Avi Mehta from Macquarie Group. Please go ahead.
Yeah, hi sir. Sir, I just had 2 questions. First, would it be fair to say that 1Q reflects the entire impact of the rise in price-based competition, and hence we should retain our expectations of flattish EBITDA margin for the full year?
Well, I would not say that it's not flattish. If you look at our trajectory for many years, except for, so if you look at it, if you look at 21-22, we were at an average of about 14%, right, on operating profits. In Q1, we are at 15.6. So what you are really looking at is the COVID periods of high numbers. So whether it's a 2021, and obviously last year we were taking price increases to make sure that we met our targets as far as inflation was concerned. So if you were to draw a line, progression line, I think we are moving in the right direction, and I think that will continue.
So I'm sorry. So should we say that at least for the near term, we are broadly done from a pricing or price-based competition perspective, and that 17.5 or 17.4 that we did, broadly flattish number, we should see. That's the right understanding, right? I wasn't sure if I got that correct. Okay.
Yes.
And the second bit, sir, is on the pricing growth. So I'm just revisiting our comments. You had said that we should expect about 2% growth is what you have built in, or you would expect for the next year or this year. Does that need to be revisited given the recent price cuts that have been done, or no, it's broadly in line with what we were kind of assuming?
What 2%? I am not aware of this 2%. What are you talking about?
So the FY24 pricing, you said volume growth will move up from what we saw FY23, and pricing will come off. And you had, at last in 4Q we were discussing that.
No, so that 2% will probably not happen this year. It seems that it will be a flattish year from a price standpoint. Venkat? Yeah. So it's not going to be a 2% increase, and the reason for that is the commodity prices. So we, with that, I think we should be in a good place to make sure that we are able to grow. Yes, on the volume front, I think we will start to see the volumes come back. But you've got to remember that last year, second quarter, we'd grown 22% or something like that.
Correct,
so
sir.
We'd had a very big second quarter. So, but I think post that, volumes in any case will start to come back.
So, so volume growth should be high single digits. That kind of expectation could probably have an upside given the pricing growth probably kind of changes. That's how I should kind of read it.
Yeah, and in our category, the way to look at volume growth is actually, the way I look at it is transaction growth. Because see, if you've taken out 3 grams from a biscuit, the consumer is not going to go and buy one more packet of yours, right? So that does impact overall volumes in terms of tonnages, but it doesn't impact the number of packets that we are selling. So our transaction growths have still been a very robust 9%. They are equal to our revenue growth, and which is what we look at. But having said that, I understand where you're coming from. I think even tonnages will start to grow as we move forward through the year.
Perfect, sir. And just a bookkeeping, sir, is it possible to share the ICDs on book? And that's the last one on bias. Thank you.
Venkat?
Yeah. So ICD as of June 30th stands at 760 crores between Bombay Dyeing and Bombay Burma.
Okay, that's all from my side. Thank you very much, sir, for answering these questions.
Yeah.
Thank you. Next question is from the line of Percy Panthaki from IIFL Securities. Please go ahead.
Hi, good morning. I was just looking at your gap between the volume and value growth. So this quarter, it's a 9% value growth and 0 volume. So it's a gap of about 9%. If I look at it in Q4, it is also about 9%. So it doesn't seem that there has been a lot of price cut or anything of that sort in the last 3 to 4 months. And yet, if I look at your EBITDA margins, even adjusted for the PLI one-offs, I think it was close to 19% in Q4, which has come down to 17.5%. So how do we explain this, that without too much of pricing, the margins have still come off and the volumes are also weak?
So in this quarter, we've taken price reversals of about 1.8%. There were fiscal benefits, which were one-time PLI accrual, which was taken in Q4 last year, which was 2.4%. So price reversals are 1.8%. Fiscal benefits are because they were taken in Q4 and not in Q1, so that's 2.4%. There's an employee cost increase, which is flattish, and there is a decrease in other expenses, which is led by advertising spends, which is about 1.2%. So versus Q4, that we are negative by 3.3%. So that is the that is the number that you're looking for, I believe.
Okay. So how do we look at margins for the rest of the year? Should we believe that unless the commodity prices change versus the current levels, the margins that you have currently sort of done is a good representative of what should continue in the future? Or do you think that it could drop further because you might take further price cuts how should I approach this? I'm not looking for a number guidance, but more of a guidance on how to think about this.
No, so the way to think about it, the way I think about it is that the priority for us, we are reasonably profitable. I think our margins are very robust and healthy. The trick is growing our top line and making sure that we get the volumes and the shares which are required, and with that will come the margins.
Okay, so it is possible that in the near term the margins might go below what we have seen this quarter. Am I reading that right?
No, you're not reading it right. I didn't say that at all.
Okay, understood. So basically, we should see a gradual recovery of volumes in tonnage, and at the same time, more or less maintaining our current margins over an average of the next 3-4 quarters. Would that be a right interpretation?
Yes.
Okay, understood. Secondly, I just wanted to understand in terms of your main growth drivers. Of course, innovation is one of them, but the second has been distribution expansion. Do you think that driver can continue to contribute at the same rate over the next couple of years as it has contributed over the last 5 years, given that as we expand more and more, the opportunity to expand sort of reduces because it's a finite game at the end of it?
I wouldn't say that. I do think, as I've told you in the past as well, the clear opportunities are in these Hindi states and certain other states as well. And we are really digging in to make sure that we neutralize those deficiencies that we have in the system. So I do think that we have a runway to gain distribution gains. But beyond that, it's also about our new categories. I think our new categories have started to perform much better. So we've seen croissants doing very well. We've seen drinks and our flavored milkshakes, etc., doing very well. Even wafers, we are putting a solid strategy to make sure that we make that into a reasonable sized business as we go forward. So all that I think is going to start to contribute more to our business as well. Obviously, as I said, that even cake and rusk, while right now they are not overweight, but as time goes by, I'm sure that they will bring their weight also to the to the other categories growth. So I think, and obviously dairy, which I have spoken about already, cheese, we've started to see green shoots of very good growth with the joint branding and the new products that are coming in. So I think all that will also add to what you're talking about.
Thank you. Sorry to interrupt you, Percy. I'll request you to join the queue again. Participants, please restrict to 2 questions per participant. Next question is from the line of Shirish Pardeshi from Centrum Broking. Please go ahead.
Hi, good morning, Varun. Thanks for the opportunity. 2 questions from my side. Now we have already started commercial production under Bell JV. So I just wanted a little more understanding on the entire dairy business. So we have our own products and now we have Bell products, which you have said that Laughing Cow has gone into the market. So 2 questions here. What is the dairy sales contributed in this quarter? And in terms of distribution scale up, what has happened in terms of Bell portfolio? Little more depth.
So we've seen double-digit growths. Well, this quarter we were just starting up, so there were some shortages as far as cheese was concerned because the Bell product had stopped coming into the market, and we were starting up to do the joint branding. So this quarter wasn't a great quarter overall, but in the 3rd month we started to see cheese volumes and revenues start to look very good, and that continues as we speak as well. So it's been I would say this quarter has been a reasonable performance, but it's very clearly showing a path to the future to us.
Okay.
Yeah.
So against last year 550 odd crore, we should be targeting strong double digit growth. That's what you're saying.
Yes.
Okay. My second question on UP and Tamil Nadu. You mentioned that there are some incentives which we have got. So what is the quantum which we have already booked in this quarter or maybe this year expected to come? And part two is that what it means to, and you said both the locations we have started 5 lines. So could you explain what are these lines we have started?
So on the incentives, UP we have still not got the eligibility certificate, so nothing therefore is recognized in the books. And TN, we have got the eligibility certificate, and a very small amount has been booked in quarter one. About 7-8 crores have been booked in quarter one.
So, sir, for full year, what is the expectation for incentive?
So we are in the process of
quantifying that out. Yeah.
Because some of these in TN, for instance, it is incremental sale that comes out of all the factories in TN. So it's not a straightforward computation. So it will take us some time before we can quantify and see what are the products which are happening in this factory and 4 other factories which are also there in the state, etc. So we'll make an assessment. Probably H1 end, we should be able to make an assessment.
Okay. And what are the lines?
Sorry to interrupt you. May I request join the queue again, please? Thank you. Participants, please restrict to 2 questions per participant. Next question is from the line of Arnab Mitra from Goldman Sachs. Please go ahead.
Yeah, hi. My first question was again actually on margins. So you mentioned you probably need to take some more price corrections, and our understanding is there is a bit of a sequential up move we are seeing in edible oils, sugar, and possibly even in wheat flour. So in this environment, do you not feel that there could be more pressure in margins in the near term, or are there other ways you could offset this situation?
No, so see, edible oils, there is no uptick. Edible oils actually are at the lowest ebb ever in the last 3-4 years. Sugar, yes, there has been a little bit of inflation, but I think the government is very clear that they want to control this. So I don't think there's going to be much inflation as far as sugar is concerned. Flour is the one which we really have to watch because there is the production hasn't been as good this year, and while the inflation currently is low single digits, but we've got to watch that. But at this point in time, it seems we are covered for the next 3 or 4 months. So we just have to make sure that we do this carefully. And obviously, we are doing things in a way that they are reversible at short notice. So we don't see a risk, but if there is a risk that emerges, we will be able to make sure that we mitigate that very quickly.
Okay, thanks. Very, very helpful. The other thing I wanted to ask was on employee cost and depreciation. This seems in the standalone and console both, it seems to have stepped up YOY as well as sequentially. Is this largely due to new capacities, and do we see these going up further as more capacities probably are in line for getting commissioned or ramping up?
See, you will see some, increase there, but there are obviously savings that we make in commitment charges as well as conversion charges from CPs. So it's a bit of a, left and right. Venkat, would you like to comment?
Yeah, no, absolutely right. So the increase in depreciation is on account of some of these units which have come up, dairy, UP, Tamil Nadu, etc. It's also the increase in employee costs that you see is partially on account of that, plus on account of the increments that have happened in the current financial year. So like Varun said, what really happens is that while some of these lines see an increase, there is a reduction that happens in the conversion costs which goes as part of the other expenses. So we have been tracking that quite closely to ensure that overall we stand to gain. And that's one of the reasons why we are putting up these factories closer to the markets.
But having said that, one thing is clear that we have to start to grow our top line faster as we go through the year. We've got capacity, and we've gotten new lines, we've gotten incentives. Now the onus is on us to make sure that we grow our volumes and our shares in each one of these markets, because that gives us better profitability. So I think we are poised very well on that.
Okay, thanks. That's from my side. All the best.
Yeah.
Thank you. Next question is from the line of Kunal Vora from BNP Paribas. Please go ahead.
Yeah, thanks for the opportunity. My first question is on advertisement spends. If I look at FY23, that number was up more than 50%, which is much higher compared to what the industry was doing. How are you looking at the number in FY24? With increased competition, would you look to raise it, or with moderation in revenue growth, you would want to reduce it?
Can you repeat the question, please?
Yeah, I was looking at the FY23 annual report, and I see that your advertisement spends are up like 62% year on year, which was like unlike most of the FMCG companies.
Oh, you're talking about last year?
Like FY23, I was looking at FY23, but I'm now asking for thoughts on FY24. About how do you...
Yeah, so 23, see, if you think about it, in 22-23, we were cycling the 21-22, and in 21-22, because of COVID and because of the inflation, we had really clamped up on our spends. So we had just normalized our spends. It was not like we'd gone completely out of whack. We had normalized our spends after those 2 or 3 years of COVID, and that's why you're seeing the increase. I think we will remain within these parameters. It's not like we are looking at taking this completely out of the charts. We will remain within those parameters as far as these spends are concerned.
So Varun, you were at 400 to 500 in the earlier years. It went to 675, which is a sizable jump. So would you remain closer to 675 or go back to the 500 levels which you had earlier?
See, we are at about, if you remove the sales expenses, we are at about 3.5% to 4% of our revenue, right? So it will remain in that percentage roughly.
Sure. Okay. My second and last question is on innovation contribution. So you have about 10. You mentioned about 10%, which seems higher compared to peers. So what is your definition of innovation, and how much of this will be new products? How much of this will be innovation of existing products?
No, that 10% that I spoke about was dairy only. Or our total innovation is about 4% currently, and it will remain in that 4%. And I have defined that for you. The definition is that products which have been launched in the last 24 months, after 24 months, they go out of the innovation bracket. And if new products are launched, they come into that. So it will remain between 4 to 5% of our total revenues.
Okay, understood. That's it from my side. Thank you.
Yeah.
Thank you. Next question is from the line of Richard from JM Financial. Please go ahead.
Hi, thanks for taking my question. Varun, hi. I want to take your inputs on how you think the metrics pan out, here onwards as we go into Q3 and Q4. The genesis of this question is that pricing growth anniversarizes completely sometime in Q2. And moreover, the price cuts that you've taken or will take further will add on to, to the price decline that could come by then. So unless volumes pick up substantially, my guess is that top line growth could look like, zero, with whatever volume growth being there, getting offset by the negative pricing. This is on top line. And on profits, your H2 last year gross margin as well as EBITDA margins were already, pretty rich at 18 to 19%. Even if I were to strip out, the bunched up PLI from the equation. Grateful if you can comment on this, if there's something I'm missing, or if you would like to throw some light on what ways are there to prop up value growth and margin as the quarters progress.
No, you're right. See, the pricing we had kept taking price increases even till the end of Q4, right? And there were some price increases which were even taken in Q1, right? So while there were price increases, there were also rationalization on certain SKUs. So we worked at both ends. And you're right about, see, last year's price increases continued till the end of the year, but the max number of price increases that we took was till Q3, right? So yes, next, we are cycling pretty high base as far as these quarters are concerned. So we will have to make sure that we work doubly hard to get our top lines to grow.
Okay. And okay, second, Varun, also wanted your view on this line called other expenses, right? I mean, this is a line that used to grow in single digit some years back and used to be the key source of margin expansion for a long period of time. The rate of growth in this line has been much higher than usual in the last 5 quarters. If you can just throw some light on the reasons for such a sharp increase in these overheads suddenly in the recent past, despite your extremely, I would say, high level of focus on costs usually.
So, if you were to compare other expenses from, let's say, last year to now, the single largest contributor in the increase has been advertisements. Okay. Advertisements, not counting promotions and trade spends. Okay, and that has grown from 3.5% of top line to 4.2 in the current year. That's something that. So what has been happening, Richard, is over the last 3 years or so, 2021 onwards, we have been spending ANSP. We have been coming back to normalcy. We have been pulling it down. So 2021 was a very low spend. 21-22, when the second wave of COVID happened, again we pulled it back a little bit. So we have been sometimes spending our normative levels and sometimes not spending at all. Therefore, you tend to see that growth. It's essentially driven by ANSP spends.
Okay.
And this is now going back, Richard, to our normative levels. As I said, it will remain in that ballpark of 4.2%. And, you'll see growths and you'll see. So now I think things are much better. COVID's out of the way and we are back to normal life. So it'll stay at about that.
All right. Thanks, Varun. Wish you all the best.
Yeah, thanks.
Thank you. Next question is from the line of Latika Chopra from JP Morgan. Please go ahead.
Hi, thanks for the opportunity. My question was on the market growth. You mentioned that the market growth has been tepid and your market shares were flattish. If you could, elaborate a little better on, any specific product segments under biscuits, which are seeing a lot more slower growth or a lot more competition, or any specific geographies you may want to call out. And I also heard you said that this could be a temporary phase. So basis your past experiences, with local competition coming back, what kind of time frame do you envisage, before, the national players, start coming back on the market share front? Thank you.
So Latika, it's also a little bit of a vicious cycle. So what happens is that in every product life cycle, you see phases when the growths or I've heard even restaurateurs saying that this quarter has been, one of the largest restaurant companies told me that this has been the slowest quarter. In fact, they're running negative, double-digit negative in this quarter. And the reason for the same given to me was that, last year there was revenge eating happening and people are normalizing, they're going out, etc. I don't think, it's such a severe impact, but yes, there seems to be a cycle. And what happens during these times when everyone in the category is hitting a wall, what happens is people tend to be desperate, right? And in their desperation, the local players especially, they tend to then, be a little irrational in what they do. So you've got to just ride out these phases and make sure that your strategic agenda doesn't change and you do not become tactical and you also start to do what the local players are doing. So we are doing exactly that. Yeah, we are trying to make sure that our strategic agenda remains our main agenda. Yes, we will do what is necessary to make sure that we do not lose space to them in the short term. And then we will come back with a bang once things have normalized. The slowness that we've seen is basically in the traditional trade markets, more so in rural. And while our agenda on rural has been fairly robust and we've been growing our distribution, but we still have seen some amount of slowdown there. And we are hoping that, that's a temporary phenomena and things will come back. And I don't think it's restricted to only our industry. I think it's a overall situation which nobody's been able to point a finger at what really is driving it. But my own hypothesis is that it will slowly and steadily come back. We just have to make sure that we drive our own agenda.
Sure. And my second question was on capex plans for FY24. We saw a significant step up in FY23, so just wanted to know what you are thinking about FY24 and if there is any clarity on FY25 capex plans also, if you could share. Thank you.
So it's going to be a continuation of what we are doing. So we've got the factories which are already in process. So there's a little bit of investment coming up in Ranjangaon, which